Greetings everyone, it's Michael Anastasiadis here, mortgage advisor from Bosanoff Mortgages, Mortgages Made Easy, coming to you live with the special announcement from the Reserve Bank today. They cut the official cash rate to 2.25%, so by 25 basis points. So that was in line with what everyone was expecting. And I've got some notes here that I'll read through because I'd listened to their press conference that they had at 3 o'clock, and I've made some notes from that and what they also put in their monetary policy statement. So bear with me while I go through this with you guys. So like I said, today the Reserve Bank Monetary Policy Committee voted to lower the official cash rate to 2.25%. Now the vote was 5-1. So someone voted to keep it on hold at 2.5. But by majority, they reduced it to 2.25%. So that's an interesting point there to note. They also said that the annual consumer price inflation increased to 3% in the September quarter. So that's at the top of the band in terms of inflation. So if it's over that band, usually they put up the rates to bring it back down. So it's at the max. However, there is spare capacity in the economy, and inflation is expected to fall to around 2% by the middle of 2026. So that's great because they're not worried about that. This is a really good point that they made here. Greater caution on part of households and businesses could slow the pace of New Zealand's economic recovery. So that means because households and businesses are not spending, it means the economic recovery could be slower. However, alternatively, the recovery could be faster and stronger than expected if domestic demand proves more responsive to lower interest rates. So what they're saying there is, with the rates now being so low, we could see more people spend and spend quickly, putting prices up to meet the demand. So that could have an impact on inflation. So on one hand, they're saying, hey, if we're not spending enough to make the economy going, they might have to do another cut. But if we spend too quickly, then they may have to put the rates up quicker. So as a result of that, the committee voted to reduce the OCR by 25 basis points to 2.25%. Future moves in the OCR will depend on the outlook for the medium-term inflation and the economy, how it evolves. So that's a sign to say that at this stage, no, they're not giving any indication as to whether future moves in the OCR will be up or down. They're just going to take a wait-and-see approach. A stat that they said today that I thought was quite interesting, 40% of fixed-rate mortgages are due to be repriced or refixed between December and March. So there's a lot of opportunity for the banks to get some business there. Now, they're doing that by offering 1.5 cash back or cash contributions. They are inundated with this sort of stuff at the moment. So if you're interested in get something like that, get in touch. But there is opportunity there for the banks to fight for business. Another thing that the committee noted was that there's also some early signs of stabilisation in labour demand, with job vacancies and total work hours increasing in September. So that's really good news because it feels like, in looking at their data, we're at the peak of the unemployment. So from here it should track downwards. So that's good news. And this is expected to broaden into a wider improvement in the labour market over the coming quarters, which should support household spending confidence. So as people may feel more comfortable in their jobs, and we're seeing that a lot with first home buyers, they're out there buying. But as people feel more comfortable with their employment, they'll spend more money as well. What else have we got here? Members discussed that house prices in aggregate have remained stable to date despite lower mortgage interest rate and a modest pickup in the housing market activity. Stable house prices could reflect weak population growth and elevated long-term interest rates. Now, I was reading some more of their stats there. They're expecting, I think, house prices to go up by around 4% in next year. So that'll be 4% growth to house prices, but nothing too crazy there. They also said that the upcoming restrictions on the mortgage LVRs, loan to value ratio requirements, and DTIs and things like that are unlikely to have a material effect because they've got those tools there that they can pull should house prices go crazy again. So the committee also discussed the options of holding at 2.25 or lowering it to 2.25. And like I said, they had that 5-1 vote. They've also said that according to their data, the economy is at the early stage of recovery and the inflation outlook provides scope to place more emphasis on avoiding unnecessary volatility. So with this context, retention of easing and overall monetary condition was delivered to date, that's been delivered to date, would support the recovery. So basically they're saying that the recovery has started and now it's a wait and see approach because future moves in the OCR will depend on how the outlook for medium-term inflation and the economy evolves. And I had a look at the projections and there's no changes to the OCR until the end of next year, this time next year, when there's a slight increase. So it looks like that the OCR at this stage, based on the data they've got, will be on hold pretty much for the next 12 months. And from there, it'll incrementally go back up because they've said that the neutral rate, so that's when the monetary policy is not stimulus or restrictive, it's just neutral, is at 3%. So at some stage, we'll see the OCR go from the 2.25 to 3%. Now, a few people have asked, hey, when can we expect the banks to make their cuts to their rates? I would expect to see cuts to the floating rates over the next 24 hours. How much? I don't know. Sometimes they pass the full 0.25, sometimes they don't, but we can definitely expect to see the floating rates drop. Now, in terms of the fixed rates, that may take a few more days or a few more weeks. So once we know that, I'll bring that to you live, but it does pay to hold and, watch my page, watch these videos and see what's out there because it will take a little while for all the banks to come up with their new rates, see if one bank will undercut the others to try and get market share, see if the other banks will match it or what they will do. So the best advice right now is if you've got a mortgage that's coming up to be refixed, speak to me, speak to your mortgage advisor, your trusted advisor, your bank, whoever's helping you for you and your circumstances to make sure you get that right advice. But for me, the big takeaways are this looks like to be the final cut. They're now going to sit back and watch us spend it to mend it. I believe that's what they want us to do, which will happen. There's always a splurge of spending over December and January with Christmas and New Year's sales and all that sort of carry on. People go away. People will be feeling better like they do over summer. So especially those that are no longer going through a change process or redundancy restructure, they'll have that confidence to go out there and spend. And, the employment stats, they look like unemployment stats will be tracking down. House prices will be stable. So it'll be a good time for people to buy with good interest rates. And they've given here some certainty that they're not looking to increase the OCR unless something crazy happens with the data until the end of next year. So that can give people confidence with the interest rate stability. But to be fair, after saying all that, the Reserve Bank doesn't have the best track record of keeping their word and with their data. So let's see what happens. Anyway, that's enough from me. Hopefully this was useful. If you want to know more, feel free to get in touch. And what I'll do is I'll come on live again tomorrow afternoon for the weekly mortgage and interest rate update. But today's live was just a special on that OCR. Anyway, guys, take care, ka kite, and we'll be in touch soon. God bless.